So says Chad Morganlander. He is our next guest, portfolio manager at Stifel Nicolaus. He helps manage, get this, $115 billion. That is a lot of money. Now, it's kind of ironic, Chad. We have you here on a day when Europe is what brought the market to its highs. You're saying you don't want any European equities. Why not?
Well, I'm currently not exposed to European equities at this point in time. Indeed, Italy is the canary in the coal mine. If you start to see the sovereign debt there trade down, as well as yield spreads widen out, you perhaps should de-risk your portfolios.
Well, given though that the 10-year for Italy, the Italian 10-year bond, is already close to 6.5. I mean, isn't it already kind of saying that?
It is indeed, but the financial system, as it's structured, can handle 6.5% yield. The big deal here is if it goes up by another 100 basis points. At that point in time, that can trigger margin calls. Credit default swaps could widen out. It could also trigger the bank stocks within the global system. That will cause massive effects there. And at this point, though, GDP on the global basis is slowing down. Valuations on the United States market here are deeply undervalued. But you have to keep this in mind.
Chad, if we do see Italian yields top 7%, top 8% perhaps, right? We've already seen this story play out 3 other times, Greece, Ireland, Portugal. What happens to the U.S. stock market? What's the downside risk?
Well, the downside risk is that credit default swaps will widen out. The banking system will also have a bit of an issue there.
The U.S.
banking system, but more in general, the global banking system also will be very stressed out.
But isn't it already? I mean, it is already stressed out. Apple's market cap is more than the market cap of all the European banks. I mean, that's some serious stress.
You're absolutely right about that. But the financial system, the credit system, is working right now. It hasn't stalled out. So, for instance, Procter & Gamble is able to roll over debt at a nice rate. The long end of the yield curve on corporate bonds isn't trading at 8% on investment-grade corporates. So we are seeing a credit system here in the United States where you can get debt rollover, where it's not as if it all just is at a standstill. That is not the case right now at this point.
Now, one thing you like U.S. corporate debt, right? That's something you find is attractive right now. Does that still hold true in the worst-case scenario right now?
Investment-grade corporate debt is right now very, very good, well priced, and that's where I would place my bet within the debt side. I would go up the quality spectrum at this point in time. If you start to see a real deterioration within the credit system where high yield debt trades at 11, 12%, then I would go down the credit spectrum and look for good buys there.
Talk about what's on your shopping list. What are you looking at?
So I like consumer staples, also like large cap technology companies, as well as consumer discretionary. I would stay within the large cap growth side at this point in time. And in fact, when you go over from the equity side to, say, the commodity side, we do favor gold.
And let's just talk about the consumer for just a minute. Are you comfortable with progress, that people are spending more money, that delinquencies are coming down? Does that give you reason to go out there and buy these stocks?
Right. Well, delinquencies are coming down. Households are delevering. When you look at the flow of funds numbers, they're continuing to pay down or write off their debt. Albeit, though, a 2% type of GDP number here can support household spending going forward. So at that point in time, you have a $90 to $100 S&P number, and that supports a $1,200 to $1,400 on the S&P.
And, all right, a 1,400 S&P by what time frame?
I would give it 3 to 6 months.
Really? So that's actually a pretty bullish outlook,
now,
which is ironic because you're positioned pretty conservatively in stocks, right?
We are positioned on balanced conservatively, okay, on a balanced type of portfolio. And you have to keep in mind, though, the canary in the coal mine is Italy, and you have $2 trillion of sovereign debt there. Any type of stress there can create stress within the whole financial system, and you would want to de-risk at that point.
Now, I know you like treasuries, U.S. treasuries. What about other sovereigns at this point?
Well, I do like U.S. treasuries, but I would go down and shorten my duration on U.S. treasuries. Take it from 15-year durations down to 5 years. That's where we are on average within our portfolios. Sovereigns, we do favor Japanese debt at this point, but besides that, we'd stay away from the core sovereigns within developed Europe right now. In particular, that we don't want real euro exposure.
And gold. You've got 8 to 10% of your money in gold.
Right.
Is that high for you?
No, it isn't. It isn't high. Well, 10% is a bit high on our more conservative portfolios. We continue to see a monetization within the central bank here in the United States. We think that that will continue going into the new year. And,
and when you say monetization, they're printing money in
large
effect,
asset
right?
purchase programs.
Which means you need a hedge, and gold would be the hedge.
Indeed, it would be. Okay, as well as you may see Germany soften their stand on regarding the ECB actually going out and monetizing. And therein lies the real trick here, because if the ECB starts to really monetize, credit spreads are going to come in, it's going to scotch the fear trade, and you could see a heck of a rally within the global markets.
All right, Chad Morganlander, thanks for joining us. He runs about $115 billion over at Stifel Nicolaus. Chad, thanks for your perspective. All right.